Stocks are off their lows, but they're off the highs because early this morning we hit record highs. But Kevin Horner, Senior Manager, Trading Services Education at Charles Schwab, is with us now. And it's interesting, we've seen some back and forth action here today. Some of your thoughts as the S&P snaps on its 8th day, snaps the 7-day winning streak at this moment. What levels are you watching, Kevin?
Yeah, we got to pay close attention here, Nicole. As always, it's a matter of time frame, but short-term traders, we made that 67.54 intraday high today, and we've basically been there for 3 days in a row trying to get that 67.50 achieved and push through it. We have not been able to do so. Today's weakness has brought us down to 6,700. That's our intraday low. Happens to coincide with the highs we made not that long ago, as it turns out. We had peaks here back on the 22nd and 23rd of September at 6,700 that brought us back to test the 20-day originally. So I think that's something that many traders are waiting on right now, Nicole, is a question of whether we hold 6,700 in the short run, and if not, then perhaps we stare at that 66.50 at the 20-day. Under the 20-day at 66.5, if we can't hold that, then we're looking at around 6,500, coincident with the 50-day moving average. So, what many traders are going to be thinking about here is, does weakness encourage them to tighten up their positions along the way? So maybe the close under 67 would be a reason for some traders to deploy, or rather pull some of that money from the market, and the SPX specifically, allowing 66.50 to come into play, and then they get kind of wait and see. But as usual, Nicole, we encourage traders to have those if-then statements ready to work so they know what they want to do if some of these breakdowns occur. Still too early to call it, I'd say, but bears probably feeling a little bit energized finally by a little bit more selling for longer than half a session, Nicole, which really seems to be about the most we've gotten lately, doesn't it?
And, you see buy the dips. I mean, it's been buy the dips. We are 3 years into a bull market. I think it's October 22nd that is the 3-year bull market. And so the question I ask many of the guests, Kevin, is, are we going into the 4th year? And most of them say yes. They don't necessarily, while we have some back and forth, people buy the dips. They don't necessarily see the reason to completely sell off. However, valuations, greed, overbought. There's things that people look at closely. Our last guest was talking about they're venture capitalists and they hold small stakes in different companies, including CoreWeave before it went public. Still holds part owner in CoreWeave still. Take a look at the chart. Tell us a little bit about the story.
Yeah, absolutely. I think that anyone owning it for that length of time is probably feeling a lot better today versus where we were, say, in the beginning of September. Most recently, what we've seen is a really strong move, breaking the downward channel here. The stock's up 50% from a double bottom achieved in mid-August and early September, essentially. And we've had an improvement to the trend. What you'll notice is that orange rising 20-day moving average coming into play once more. In fact, today's intraday low on CoreWeave seemed to test that 20-day moving average. The low today, 126.36, and according to my detail at this moment, the 20-day moving average is 126.25. So it would make sense as an area for a short-term test of support. Now, if the 20-day, by some measure, doesn't hold on a closing basis, things could get a little dicey for short-term traders here. Under the 20-day could bring the 50-day at 113. That'd be about a 10% drawdown further. So as always, traders need to be positioned even for moves they don't think can occur. But it's an improving chart. You've got reasons for bullishness, but as always, set those levels, know where you'd look to move on if things don't maintain.
Yeah, and last but not least, what about Reddit?
Well, Reddit was a darling, right? It had a really great run here from early April all the way into September's peak on the 19th. But since then, we've had about a 30% pullback to an area that could offer support here around $200 a share. What I've drawn in are a couple of key components. The first is an educational reminder relative to that prior high at 280. We had that one-day shooting star candle, and everything kind of fell apart from there. The reason I bring it up, those are an instance where a trader might say, you know what, this is a good chance for me to take a little profit, pat myself on the back. Let's see if that longer term trend holds. Well, clearly it hasn't. And what you've got now could go either way. You've had that 30% pullback off the peak. We've settled in over the last 5 to 7 sessions and holding the 200-day moving average. But what I've drawn in is this bear flag in the white pattern. Essentially, the bear flag looks to suggest that a break under 200 could bring Reddit down to the 200-day moving average or even below it at around 155. I've got the 200-day right now at around 162, 163. So traders in the short run, if you're long, you could set up here for a bullish opportunity for a rally from a proper risk versus reward standpoint if you think it can get back to the prior highs. But under 200, once again, things get a little bit dicey. Could be a momentum-based sell down to the 200-day moving average and the potential for a measured move down to around 155. None of which is ever a guarantee, but that's why we talk the technicals, Nicole. We like to set those levels and evaluate what might happen so that in the moment, if things start to crack or shift, then we know what we want to do.
That's what the pros do. They're ready for all scenarios, any and all scenarios. Kevin Horner, Senior Manager, Trading Services Education, every technical Tuesday. Thank you. Charles Schwab is here. Thank you, Kevin Horner.